Before 2008, the rules of finance were straightforward. If you wanted to hold your money, approve a payment, or send cash across the globe, you asked a bank for permission. They were the undisputed gatekeepers of the global economy. Behind those closed doors, institutions bundled highly speculative mortgages and sold them to global investors. The system relied on homebuyers making payments they could not afford. When those buyers began to default en masse, the housing market collapsed. The damage extended far beyond the real estate sector. Cascading bank failures wiped out millions of jobs, eroded life savings, and decimated retirement accounts globally. In response, governments stepped in. They printed vast sums of taxpayer money to bail out the very same financial institutions that had engineered the crisis. Watching Wall Street recover while everyday citizens lost their homes broke a deeply ingrained societal contract. People began asking why centralized banks should retain absolute control over their wealth. On October 31, 2008, a 9-page paper appeared on a cryptography mailing list. The author used the pseudonym Satoshi Nakamoto. The paper proposed a peer-to-peer electronic cash system. It outlined a method for strangers to exchange value directly, completely outside the jurisdiction of corporate executives, presidents, or central banks. Instead of relying on a human-run institution to keep honest records, this system would trust mathematics. Cryptography and decentralized consensus would replace corporate ledgers. Satoshi's true identity remains unknown today. Because there is no CEO or central founder to subpoena, pressure, or compromise, the network operates without a single point of failure. But to remove the middleman, Satoshi had to overcome a technical barrier that had stalled computer scientists for decades. Digital files, like photos or MP3s, can be copied and pasted infinitely. If you can copy a digital coin 1,000 times, it has no value. This is known as the double spending problem. Satoshi detailed a transparent, shared ledger. Instead of one bank, thousands of independent computers maintain the exact same transaction list simultaneously. If someone attempts to duplicate a coin, their ledger won't match, and the network immediately rejects the fake transaction. On January 3, 2009, Satoshi mined the very first data block. Embedded in the code was a newspaper headline about the UK government preparing a second bailout for banks. The blockchain was live. It demonstrated that it was entirely possible to maintain strict digital scarcity and verify ownership without forcing users to trust a central authority. With no corporation running the servers, the system required a self-sustaining way to verify transactions and completely protect against fraud. The protocol introduced miners. These are computers competing to solve complex cryptographic puzzles. The first computer to solve the puzzle earns the right to add the next batch of transactions to the chain, receiving newly minted Bitcoin as compensation for their computing power. There is no headquarters. Copies of this ledger are maintained on tens of thousands of independent machines, from home computers to massive data centers globally. For the first year, these digital tokens traded for fractions of a penny. Then, in 2010, a programmer successfully exchanged 10,000 Bitcoin for 2 pizzas. It was the network's first real-world commercial transaction. That single purchase proved the token held actual transferable value, kicking off a surge of global interest from developers, merchants, and investors. This chart shows the money supply rules programmed into Bitcoin's code. While traditional fiat currencies can be printed indefinitely, Bitcoin is mathematically capped at exactly 21 million coins. No government, corporation, or even the original creator can alter that limit to produce more. The scarcity is locked into the protocol. Financial institutions and massive investment funds now allocate capital to Bitcoin for this specific reason. They view its fixed supply as a hedge against inflation, operating similarly to physical gold in a portfolio. In regions suffering from hyperinflation and strict capital controls, citizens use the network to store whatever wealth they have left, moving value across borders without relying on a rapidly devaluing local currency. The rigidity of the code offers a mathematical alternative for individuals seeking autonomy from domestic monetary policies. The network still faces friction. The price of the asset fluctuates wildly, making it a high-risk proposition for everyday retail payments. The mining process also requires enormous amounts of electricity. While operations are increasingly moving towards surplus and renewable energy sources, the environmental footprint remains a subject of intense debate. Governments are deeply divided. Some nations have adopted it as legal tender, while others have implemented total bans, viewing decentralized cash as a direct threat to state control over local economies. Yet the network has run continuously for over a decade. It spawned a multi-trillion-dollar digital asset industry and forced regulators to reevaluate how global finance operates. A 9-page document published during a financial collapse proved that a borderless, decentralized currency could function, secure itself, and scale globally without a single human ruler.